So coming to the next topic, accounting for government grants. So generally, government grant covers it is a one type of assistance provided by the government to the entity. So either in monetary terms or in non-monetary terms. So here, in terms of the monetary terms, like for example, so if the if government give a proposal, so if you start the entity in our state and provide the employment, provide around 50% of the employment to the local public, then they will provide 30% of the employment cost. So that type of assistance provided by the government. And in some cases, so if you start the entity, then we will provide some tax holidays to you for some period, like 5 to 10 years. And that type of assistance is provided. Those are covered under non-monetary, and the first one is covered under what monetary item. So that type of assistance provided by the government to the entity for promoting the goods or for uh, marketing or promoting the local employment, promoting the local employment. So that is said to be about government grant. So generally grant is provided by, so first of all, how to recognize, so when to recognize the government grant, when to recognize. Generally this government grant is recognized when there is a reasonable assurance, when there is a reasonable assurance, so regarding the receipt of the government grant. So when we said the reasonable assurance, so first one is, so if the entity comply with, if the entity comply with conditions attached to the grant, conditions attached to the grant, as we already discussed. So for example, so coming to our state, AP state is there, AP state in India. So this is a recently established state, and it was divided from the United AP. So in that case, so we need to form the capital. For that purpose, AP government give the proposal to the entrepreneurs to start their entities in AP. Like if you start the entity and provide the employment to around 40% of the employment to the our local public, then AP government will provide 30% of the employment cost to you as a grant. So here, if that condition satisfied, then only you will receive the 30% government grant from the AP government. And and the second one is grant will be received, and grant will be received. If these two conditions are satisfied, then only we recognize the grant. Then only we can recognize the grant. And generally, grant provided by the government relating to the two cases. One is relating to the assets, means non-current assets, and relating to the revenue, nothing but what others. If the grant is provided relating to the acquisition of the asset or construction of the asset, acquisition of the asset or construction of the asset is called as what capital grant, and otherwise that is called as what revenue grant, otherwise that is called as what revenue grant. So here capital grant is nothing but what the grant provided towards the acquisition or construction of the non-current asset like property, plant and equipment. So that is said to be a capital grant, otherwise that is said to be a what revenue grant. So revenue grant. So then coming to the revenue grant. So generally, coming to the accounting for revenue grant. So in case of if the revenue grant received, then we can account it for two ways. The first one is, so either reduce from the corresponding expenses, either reduced from the corresponding expenses, or it may be shown as a income under the head other income in the statement of profit and loss. So that revenue grant received by the government, received by the entity may be reduced from the corresponding expenses, as we already discussed. So if that grant received relating to the payment of salaries, then we received what? Debit bank account, credit salary account. We reduce from the corresponding salary. So, or we may show it as another income like debit bank account and credit. So, other income or grant received account. And it is shown under the head what? Other income in the income side, in the income statement or profit and loss statement. So, in the profit and loss statement. These are the two ways of recognizing what? Revenue grant. So for example, in future, if the conditions are not satisfied by the entity, so first of all, revenue grant is provided by the government because of those attached conditions satisfied by the entity. So for example, if that conditions are unable to fulfill in future, if that conditions are unable to fulfill that conditions in the future, then company is liable to refund the government grant, to refund the government grant. And that refund may be, that refund may be to the extent of full government grant or in proportionate or in lump sum stated in the respected grant, respected conditions. So for example, if that is happened, if that is happened, then what about the refund? What about the refund? In case of the, if the refund of the government grant is required, then just add back. If you follow this method, there are two methods are there initially recognized while receiving the revenue grant, right? The first method is reduce from the corresponding expenses. Reduce it from the corresponding expenses. The first method is reducing from the corresponding expenses. If you follow this method, while refunding the grant, we have to debit that amount to the corresponding expense, and just we reverse the entry, debit salary account, credit bank account, credit bank account. And simply said, we add back the amount of refund of government grant to the corresponding expense at the time of refund. And in this case, so in this case, so the total amount of whatever you considered on the credit side of the statement of profit and loss as an income under the head other income, so will be refunded, will be refunded. Then we have to treat so debit grant account, credit cash or bank account, and will be treated as a what? Expenses, and will be treated as a what? Expenses. So this is what revenue grant, initial recognition plus in case of any refund, what is the journal entries. Next, coming to the capital grant. So in case of the capital grant, so capital, what is meant by capital grant? As we already discussed, the grant received towards the purchase of or construction of non-current asset is said to be about capital grant. When the capital grant received, there are two ways are there for recognition. The first one is reduce from the book value of that non-current asset, reduce from the book value of that non-current asset, or show it as a deferred income. Show it as a what? Deferred income. So in the first one, there are two methods are there. Coming to the first method, deduct the grant from the cost of the non-current asset or depreciate the remaining amount. And method two, recognize the grant initially as a deferred income and transfer the portion of revenue each year, so offsetting the higher depreciation charged based on that original cost. So then, how to recognize? How to recognize? For example, X Limited purchased so plant and machinery for 10 lakh dollars. When the asset purchase, they write the entry debit plant and machinery account, credit bank account. So 10 lakhs. And at the end of the year, they provide the depreciation. So debit depreciation account or credit accumulated depreciation account, say 1 lakh. Say 1 lakh. Then in the balance sheet on asset side, under the head non-current asset, they show the PPE as how much amount? 9 lakh. 10 lakh minus 1 lakh, how much amount? 9 lakh. Then if the grant received, so grant received to the extent of 5 lakhs, to the extent of what? 5 lakhs. Then there are two methods are there. So in case of method one, in case of method two. In case of method one, that grant received is reduced from the book value of the asset, book value of the asset, and apportion the remaining over remaining useful. So here the book value of the asset is around 9 lakh. Then we reduce the grant received, so 5 lakh, and the remaining revised book value is 4 lakh. Out of 10 years, 1 year we provide the depreciation. Then the rest of the remaining useful life is 9 years, and this 4 lakh is allotted over this 9 years. Then revised depreciation is equal to 4 lakh by 9, equal to 44,000 for 44. This is the entry. And for this, what is the journal entry we recorded? Debit bank account, credit PP, property, plant and equipment account. So generally we have to adjust the accumulated depreciation account also, right? So first we have to write what? That accumulated depreciation is transferred to PP, then debit accumulated depreciation, credit PPE, that 1 lakh is a transfer, then we write this entry. Then coming to the second method, in this method what? So that amount of grant received is treated as a deferred income. That amount of grant is received is treated as a deferred income. Then we write the entry debit bank account, credit deferred income account, how much amount? 5 lakhs. How much amount? 5 lakh is there. So then how to show in balance sheet? So on the asset side, so on the asset side, under the non-current assets, under PP, they show the 9 lakh. On equity and liability side, under non-current liabilities, they show it as deferred income. How much amount? 5 lakh. They show it as a deferred income. How much amount? 5 lakh. Then at the end of the second year, they provide the depreciation. then debit depreciation, credit accumulated depreciation lakh. And this 5 lakh is apportioned in the proportionate of depreciation over the remaining useful life, and every year that apportioned amount of deferred income is transferred to profit and loss account, is transferred to profit and loss account. Then we write the entry, so debit deferred income, so credit statement of profit and loss. So this 5 lakh is allotted over the remaining useful life in the proportionate of our depreciation. So the rest of the useful life is 9 years. So 5 lakh by 9. So how much amount? 55,555. This is what we require to provide. 55,555. Okay. So this is provided in the second year, in the third year, in the fourth. Every year we need to write in this way. Okay. So in this case, in the method one, the amount of grant received is deducted from the book value or cost of the non-current asset and depreciate the reduced cost over the remaining useful life. And coming to the method two, it is shown as a deferred income and transfer a portion to the revenue. Revenue is nothing but what? Statement of return loss each year. So offsetting the higher depreciation charge based on the original cost. So that means, so we have to apportion the respected deferred income in the proportionate of what? Depreciation every year. In the proportionate of a depreciation every year. So this is relating to the accounting for capital grants. Accounting for capital grants. Okay. Then, so repayment of the grant. The next one is what? Repayment. Already we discussed. So repayment stands for what? Refunded. So in case of so same way we have to verify in case of revenue grant, in case of capital grant, what is the treatment? In case of revenue grant, already we discussed. So when the revenue grant is treated as a reduction from the cost of the reduction from the corresponding expense, then at the time of refunding, that amount is added to the respected expenses. Then second method, so when the revenue grant is credited as an income under other income to the statement of profit and loss, when the amount refunded, we have to debit that amount to the P&L statement as a debit grant refunded credit cash or bank account. Next, coming to the capital asset. Coming to the capital asset. So for example, in this case, refunding happened. So grant required to be refunded around, for example, so 3 lakh. So maximum grant required to be refunded to the extent of grant allotted. To the extent of grant allotted. So what is this method? This method is nothing but first method in capital grant means so that grant received is reduced from the cost of the asset. Then at the time of refunding, first calculate what is the book value on the date of refunding government grant plus the amount refunded is added to the respected book value. Amount refunded is added to the respected book value, and the remaining is said to be a revised book value and is allotted over remaining useful life. Remaining useful life. So what is the book? For example, at the end of the first year, at the end of the first year itself, the end of the first year, so that refund is sorry, at the end of the second year, at the end of the second year, that refund is happened. And then what is the book value? So 4 lakh is there. 4 lakh minus 44,444. So 3,55,556. So amount refunded is 3 lakh. then 6,55,556. Out of 10 years, 2 years completed. Then remaining how many years? 8 years. This is allotted over 8 years. Then what is the depreciation? So by 8 equal to 81,944. This is the amount of depreciation from the next year onwards. Then in this case, what is the procedure? In case of deferred income, if the capital grant is assumed as a deferred income, so in that case, so first calculate what is the balancing figure on the date of refunding relating to the capital grant. So just in T-shaped format, just I will write for understanding purpose only, I will write balance sheet in T-shaped format. So on assets under PP, so 9 lakh minus we provide the depreciation, then 8 lakh is there. On liability side, we have deferred income. So 5 lakh minus 55, 555, right? So 4 lakh 44, 445. So if that amount is refunded, just we write the entry debit deferred income credit bank account. So here how much amount is refunded? So as we already considered 3 lakh. So verify whether sufficient amount available in deferred income or not. So here 4 lakh 44, 445 available. So we need to refund only 3 lakh. Sufficient amount is there. So we pay the amount. And the remaining amount of deferred income, how much amount is there? 1 lakh 44, 445. This amount is allotted over remaining useful life in the proportionate of our depreciation. Okay. Then, for example, the balance available in deferred income, just assume here 4 lakh 44, 445 is there. Just assume in this case, the deferred income balance is there around 2 lakh 50,000. 2 lakh 50,000. But how much amount required to refund? 3 lakh. Then sufficient amount is not available in deferred income. Then in that case, then the rest of the balance is taken from what? Profit and loss. Then we have to write debit deferred income and the debit statement of profit and loss credit bank account. So first we have to refund the amount from the deferred income account. And if that account is not sufficient to refund, then the balance is taken from the statement of the profit and loss. So where the deferred income is transferred in the proportionate previously to the credit side of the P&L. So this is the treatment of what? Refund. So need to be repaid if the conditions of the grant are breached, means violated. So if there is an obligation to repay and the grant and repayment is probable, then we have to consider it as a change in accounting estimate. As per IAS 8, change in accounting estimate. So if the deferred income method of capital grant has been used, then the remaining grant will be repaid to the government. Any amount released to the profit or loss may also be need to be reversed. When this amount is reversed from the P&L, if the deferred income is not sufficient to repay. And in case of netting off method means that grant received is adjusted to the capital asset, then cost of asset must be increased to recognize the full cost of asset without grant. Then liability will be set up for grant repayment. Liability will be required to be set up for grant repayment. So this is what, so relating to the government grant and IAS 20.